Hey, what's up everybody? It's Mikhail, and in this video I'm going to teach you the fundamentals and basics of options trading. So I've been trading options for about 6 months now, from December 2019 to now it's the end of May 2020, and I've made some significant gains, so I wish to pass on that knowledge, that game on to you, and hopefully you can have similar successes. Options trading may seem very scary to many, but I'm going to break it down in the very simplest form. "6:30 a.m. to 1 p.m. are options hours. That is Pacific Standard Time. From 1 p.m. to 5 p.m. those are after hours. And after hours there are no options trading. It is very low transactions, small transactions. Most people do not trade on the after hours, and then from after hours it goes to futures. And futures, it's best to wait till 7 p.m. Because you get more time to see where the market is. That gap from 5 p.m. to 7 p.m. really does reflect where the market is turning to. And futures are basically the global markets and showing the direction of where markets will be the next trading day. From 1 a.m. to 6:30 a.m. that is called pre-market. Again, there's no options traded. Pre-market is very similar to after hours. It's very low volume, and basically that gives you an idea of where your stock will be trading during regular stock market hours, which is 6:30 to 1 p.m. and stock market hours are also options hours. Hope that gives you a clear understanding on what the scope of options hours are compared to just the overall market hours, which is 24/7. When they say money doesn't sleep, it's true. Money does not sleep.
Rich people don't sleep 8 hours a day. That's a third of your life. It ain't but 24 hours in a day. You cannot be sleep 8 hours a day. You can't live in LA and wake up at 8 o'clock in the morning. It's 11 o'clock on the East Coast. The stock market been open 2 hours. They already making decisions about your life, and your ass was asleep.
What's an option contract? One option contract is equivalent to 100 shares of a stock. So if I were to buy one option contract of, say, Apple, that's equivalent to 100 shares of Apple stock. That's the simplest form I could give you of what an option contract is. Up next are two phrases that you will hear a lot of in the options market. Number one, a call. A call is basically a bullish bet. A bullish bet means you think the stock is going to go up. So if you buy a option contract and you think it's going to go up, you would be buying a call option contract. Number two, a put. A put is basically a bearish bet, a bearish position. You think the stock is going to go down. So if you were to buy one put option contract, that is one contract betting the stock will go down. So calls, stock is going up. Puts, stock is going down. Those are calls and puts. Bears and bulls, pick your side. Next up, what's a strike price? A strike price is basically the target price that you think your option contract will reach. So say company ABC is trading at $100 and you think they will reach $110. That $110 is your strike price. That is your target price, and that's where you believe it's going to go. That is going to be a call. That's a bullish bet. Same way, your strike price can be a put, a bearish bet, where say company ABC is trading at $100 again, and you think it's going to go to $90. So you buy a put option contract for a $90 strike price. That is essentially what a strike price slash target price is. Now that you guys know what a option contract is, a call contract, a put contract, and what a strike price, the final component of a whole option contract is a expiration date. An expiration date is basically the date you think your strike price for your option contract will be hit. So if I were to select company ABC, which is trading at $100 per shares, and I have a strike price of $110, so I just purchased a call contract for $110 for company ABC. The next part of that contract component is the expiration date, and I will have to select a date where I believe that strike price will be hit before that expiration date. Every expiration date lands on a Friday. That's just the way the market has assigned it. So you'll see when you trade on Robinhood or Schwab or Fidelity, every option has an expiration date. That expiration date is on a Friday. So you selected your stock, company ABC, you know your strike price, $110, and you're gonna put your expiration date, say 3 to 4 weeks out, typically. That gives you enough time so your current stock value can reach that strike price. Because if it does not hit that strike price, your contract and all the money you invested will be expired, worthless. So you want to give yourself enough time to hit that strike price. So always pick an expiration date at least minimum 2 to 3 weeks out. It will save you the stress of basically waiting for a stock to hit that strike price, because sometimes you don't know what's going to happen. The markets are unpredictable, so always good to have that cushion for your expiration date, at least 2 to 3 weeks out. So once you look at your option contract, you've selected the strike price, the expiration date, you go in and you look at one of the main things, what I look at first is the volume. Volume shows how many trades or transactions have occurred on that specific strike price contract with that specific expiration date. You want to have a option that has high volume. Anything over 1,000, that means it's a very liquid option contract. That means you will be able to exit that contract fairly quickly because you know other traders are trading it. You don't want to ever be in a option contract that has very low volume, because volume basically indicates liquidity, and you want to be in a very liquid stock because that just positions yourself for flexibility. So you see a option contract with high volume. Now you look at the details of it, and one of the two categories is the bid. The bid is basically the price that buyers are willing to pay for that specific option contract. The second category you'll find are the ask. The ask is what a seller who currently owns that specific option contract, what they're willing to sell that contract price for. So ask, that means someone is selling that contract for that price, and a bid, you're bidding, that's a buyer, they're trying to buy it for that specific price. Ask and bid, that's the next component when selecting an option contract to buy. So you know what an ask is, you know what your bid is. Now what's a limit price? A limit price is essentially the price that you're limiting you're going to purchase at. That's going to be the cap that you're going to put in when you put in your order. So say an option contract is going for $10. You could put a limit price in for $9.50. Now if it goes over to $10.10, you will not get your order filled. But if the stock or the option contract is dropped, it will be filled. Now, the limit price, you can manually enter to any price you choose. Remember, you have the ask and the bid. The ask are sellers selling at the price they want to sell their contract at, and you have the bidders who are bidding to buy. So when you put in your limit price, you actually jump into the bidding category side. Remember, every option contract, for every one contract, you multiply that by times 100, basically. It's 100 shares. So one contract, so if a limit price, say, is $10.20, that one contract is worth $1,020. We have this thing called time decay. This is exclusive to only options trading. And what time decay essentially means is company ABC, they're trading at $100. You have your strike price at $110 and the expiration date for 2 weeks from now. Let's say tomorrow morning, the stock trades at $95. Now, time decay is basically an algorithm and it's predicting the future price action of the stock and the probability of that stock hitting the strike price. So if your strike price is getting further and further away from the current actual price of the stock and the expiration date is nearing closer and closer, your option contract will start losing its value very, very rapidly. And that's basically what time decay is. Time decay is factoring in the expiration date with the amount of time that your strike price will hit. And the further apart those two are, the faster you're gonna lose your money. So this is why it's very important to always have cushion. Buy your expiration dates 2, 3, 4 weeks out in advance, because you don't wanna ever be in a position where the expiration date is very close to your strike price and you are very far away from hitting your strike price. That means your time decay will start hitting, and that time decay will start taking huge, significant chunks out of your option contract, and you will lose significant money very quickly with a chance of basically selling for a loss, or you're going to hold it for the expiration date where the option contract will expire worthless. So with time decay, there's also a category called the Greeks. The Greeks are stats. There's 5 of them, and the one we're going to focus on right now is called Theta. Theta. And what theta is basically the measurement of the rate of decline of the value of your option through the passage of time. So you have a option with a strike price and an expiration date, and the lower the theta is, theta, like I said, will always be a negative number. The lower the theta is, the higher chance of that strike price being hit by that expiration date. The higher the theta price, it will be a higher chance of you losing that option and potentially losing all your money. So you always want to have a theta lower than 5 for me, but I mean, depending on your risk, because hey, if you are right and theta say is a -20 and the next day news comes out and that stock skyrockets, you will make at least 100% on your initial investment on that contract. But if you're wrong and that expiration hits and that theta keeps on climbing, you're probably gonna have your contract expire worthless. So always look for a theta. It will always be a negative number, and always make sure it's under -5, because you don't want to get burned. You want to protect your money. Your money is your investment, and we're here to win. So futures, like I mentioned earlier in the beginning of the video regarding the time, futures run Pacific Standard Time from 7 p.m. to 1 a.m. Now, futures are going to give you an indication of where the stock market will be the next trading day. There are 3 different categories for futures that we look at: the Dow, the S&P, and NASDAQ. Those 3 categories, I'll post a link at the bottom, and basically you can find out what stock you own and what category or index that stock belongs to. So when you look for futures, I'm going to help you out, give you an app also to download, investing.com, that app, and that will show you the futures from the hours of 7 p.m. to 1 a.m. West Coast time, so you can always see where your specific index is going, and that will carry over into the pre-market hours like I described. So futures are very important. You'll be looking at them as soon as the stock market is closed, especially when you're making a lot of money. So there's a thing called earnings reports. This is when companies report their previous quarterly earnings for the past 3 months, and they've given estimates along with analysts, and when they report, they either meet estimates, miss estimates, or exceed and beat the estimates. My previous experiences to stay away from earnings. I will buy calls 1 to 2 weeks after earnings, a close enough strike price, and I will play the momentum and the hype leading up to earnings, but I would sell prior to earnings being released. Earnings can be released pre-market or after hours. You don't ever want to hold earnings or hold your options or your calls or your puts into earnings, because you just don't know. I've learned the hard way. It's a risk, it's a gamble. You're always better off securing profits, especially when you don't know the health of a company. And right now we're in a situation where there's quarantine going on, so companies aren't performing and it could be a hit or miss. So be safe, ride the hype, ride the momentum up into earnings, sell prior to the company releasing their earnings, and I promise you, you'll make more money and you'll have less stress playing it that way. Day trades. What a day trade is, you purchase a call or a put option today and you sell it before the closing bell the same day. Simple as that. That's a day trade. If I were to buy a call or option today and sell it tomorrow, that does not count as a day trade. That is categorized as a swing trade. Now, with any account under $25,000, you are limited to 3-day trades. After you use your 3-day trades, you will have to wait until the next 5 trading days, and then all those day trades get reset. Now, if you were to do a 4th day trade before the 5th trading day, that 4th day trade will become a final trade, and you will be suspended for 90 days from conducting any day trades. That is a federal law that has been placed unless you have over $25,000 in your trading account. If you have more than $25,000 in your trading account, you can do unlimited day trades. So that is a law that has been put into position, so the smaller accounts can't day trade. And if you do day trade, you're limited to 3. And once you use one, you gotta wait 5 whole trading days, and then that one is removed. So be careful, use those day trades sparingly, don't use them, because you don't ever know if there could be a market sell-off, and you don't want to be in a situation where there is a market sell-off and you're unable to sell your option because you've used and exhausted all your day trades. So always keep one on deck, ready to go, and if you get your account to over $25,000, you don't have to worry about that. That's a wrap, guys. Thanks for tuning in. I hope I covered everything in detail. If I didn't, please let me know in the comments below if you would like to see more specific examples or details on the various topics I've discussed regarding options trading. Yeah, I know it's a lot to consume in one video, I hope that it's given you some confidence and a better understanding on what options trading are. And if you guys want to see anything else, let me know. I'm here. I trade heavily on stock twits, so you'll see all my trades. Follow me, Mikhail 507. I'm here to interact, engage, learn from you guys, and hopefully we all make some good money. And be careful investing. Don't invest something or an amount that you're not willing to lose, because options is a very, very risky game. But if you know how to execute properly and study and do your due diligence, you can be very, very lucrative in this game, I guess you can call it. All right, good luck, guys. Take it easy.